Today I'm going to talk about my paper that I wrote for this conference, which I call Banking Crises Under a Microscope. And the reason I call this paper Banking Crises Under a Microscope is that I want to discuss and survey a lot of new recent research that uses detailed quantitative micro-level data to reconstruct the global history of banking crises. And the goal of this new research is to zoom into these historical banking crises and to be able to see them in high resolution and clarity and detail, and to be able to study them in many of the same ways we study in the same detail the 2008 global financial crisis. And in many ways, this new research challenges many of the incorrect assumptions we hold about banking crises in the past. So I'm going to survey many of the new tools and data sets that have been developed and a lot of the research that is being done. And I'm going to spend most of my time talking about a particular paper I've worked on recently with Verner and Xiong, where we look at the history of banking crises in 46 countries from 1870 to the present through the lens of bank equity prices. But then at the end, I'm going to talk about other research done by me and others, including ongoing projects, and showcase other papers such as ongoing work that I'm doing with Moritz and Casper, among other projects. And this other work, for example, looks at banking crises through the lens of individual bank balance sheets of all the banks in 17 countries from 1870 to the present, and to assess credit booms and financial crises in this very granular micro-level detail. So let me first talk a bit, the next 15, 20 minutes or so, about some of the findings in my paper with Emil and Wei. So we call this paper Salient Crises, Quiet Crises. We all know, for example, that banking crises often coincide with severe macroeconomic crises. Existing chronologies of historical banking crises are based almost entirely on narrative historical approaches due to lack of quantitative data. For example, Jorda or Reinhardt and Rogoff identify banking crises by looking through historical narrative approaches, looking for the presence of things like bank runs, bank failures, and they call anything that looks like that a banking crisis. But as Romer and Romer point out in a recent paper, these narrative approaches can be problematic because narrative approaches they say are subjective, qualitative, and they have a backward-looking approach to identifying crises. This could lead to a look-back bias because historians may be more likely to select out crises that were the worst macroeconomically exposed, leading us to overstate the average severity of banking crises, among other issues. And then there's other issues with these narrative-based approaches. One issue that we point out that's very much related is just that there seems to be no precise definition in any of these narrative approaches, with maybe the exception of Levin and Valencia, of what a banking crisis exactly is. And the issue is, if you line them all up, these different approaches, you'll see that the result is quite startling, that they drastically disagree with each other. Take the example of banking crises in Germany. Though in our paper we show that the issue is not just Germany, it's the same for France or the UK or the US or Japan. You line up 6 prominent narrative-based approaches like Reinhardt and Rogoff, Schulerk and Taylor. The way we do this is we put the starting year of a banking crisis in black if that paper calls it a banking crisis, a 0 in red if that paper says it's not a banking crisis, and we leave it blank if it's outside the paper sample coverage. So there's some agreement here. Everybody agrees in Germany that 2008 was a banking crisis, but there's a whole lot of disagreement for these other events. Is 1873 a banking crisis or not? How about 1880, 1891, 1907, 1925? For a majority of these events, there's disagreement about which of these are banking crises, which calls into question, are these banking crises? Which characteristics should we look for? How do we define banking crises? So our paper takes a very different approach to studying banking crises, and we use bank equity returns to better understand the relationship between the banking sector and the broader economy. So bank equity returns has several advantages in the study of historical banking crises. It overcomes many of the objections of the Romers. For example, it's objective because it's based on hard information. It's real-time in the sense that it's recorded by investors at the time of the crisis, in the middle of the crisis, and not retrospectively. And it's quantitative, so we could put an intensity measure on the severity of crises. But another, perhaps even more important reason to use bank equity returns is that it's theoretically motivated. In models of banking crises, such as by Holmstrom and Tirole or Gertler and Kiyotaki, or really any macro model with financial frictions, bank equity is the key state variable that determines the ability of banks to intermediate funds between savers and firms and households. And in our paper, we find consistent with this theory that empirically, across a wide range of countries and a big historical sample, that bank equity returns are highly informative about future macroeconomic consequences. And not just conditional on banking crises from these previous narrative approaches, but actually quite generally, even outside of them. There's something very general about the predictability coming from bank equity returns. We show that large declines in bank equity, controlling for non-financial equity, predict large persistent credit contractions and output gaps. And we thus use large declines in bank equity, as a measure of the impairment of the banking sector, the undercapitalization of the banking sector, at least as perceived by equity markets. And it serves as a continuous measure of banking sector distress based on information incorporated by equity markets at the time. Maybe the most important reason we think to use bank equity returns is that it could allow us to study what we think of as the full spectrum of banking crises, not just the ones traditionally defined by the narrative-based approaches. So if you think of all large bank equity declines in our data, you could think of them as fitting into three categories. So some of them are sort of just the episodes that are traditionally defined as banking crises by narrative-based approaches, because they feature salient features like bank runs and large-scale government intervention. But then you might have these other types of events which are less obvious, which may go undetected by the historians because they don't have these salient features. Another type of banking crisis is what we call quiet banking crises. Episodes, or actually we define these as non-panic bank distress episodes. Episodes in which there's large impairment to the banking sector, but because usually of forceful government liquidity backstops, there are no overt runs and panics, and so the banking distress remains in some sense hidden. And these may go undetected by narrative approaches. And then a third type of banking crisis that might go undetected is banking crises that initially appeared bad, but quickly recovered, either because there just happened to be positive shocks or maybe from very early forceful government action into the banking sector. And so these crises in some sense might go undetected because they in some sense never happened. They were quickly resolved and they're not counted as banking crises. But yet these might be some of the most interesting events to study because they were successfully averted. So what do we do in this paper? Well, we take, again, a new approach to studying historical banking crises. We build a new data set on bank equity index returns covering 46 advanced and emerging economies from 1870 to the present. And with this data set, we put forward the following 4 findings. So first, we show that bank equity declines predict persistent credit contractions and output gaps. Second, we provide evidence on these quiet banking crises, especially episodes of non-panic bank distress. We show that bank equity declines without panics also predict substantial adverse future outcomes, whereas panics without bank equity declines predict no adverse future outcomes. The third thing we're going to do is we're going to take advantage of another property of bank equity returns, which is historically they allow us to see things in higher temporal resolution, to understand the dynamics and the turning points of banking crises as understood by equity investors in real time. And we're going to show that around banking crises, bank equity declines tend to precede panics and other crisis indicators, and we're going to tie that to theories of historical banking crises. And lastly, we're going to use bank equity returns to uncover some forgotten historical banking crises that have been lost to historians. We're going to do some financial archaeology. And we're also going to create at the same time a new chronology of historical banking crises, at least a particular chronology where we emphasize or we define banking crises based on 2 specific features: large aggregate bank losses and widespread bank failures. Okay, so why use bank equity returns? Well, besides all those reasons I talked about earlier, I mean, one practical reason is just simply the abundance of bank equity data historically. It was quite surprising how much bank stock data we could find going back to 1870, even in countries you'd call emerging economies today, like Argentina, Brazil, Chile, Egypt. Who knew there were bank stock prices available going back to 1870 in these countries? And the reason is, if you look at historical financial newspapers in these countries, bank stocks were actually very prominent. They were traded, they were invested in, they were actively followed as much as, say, railroad stocks. They were important stocks of that era, and they were easy to find. Another thing that's important to know about bank stocks is that from 1870 to the mid-1930s in all these countries, in other words, an era with a lot of historical banking crises, nearly all the major commercial banks in all these countries were publicly traded. They were not private banks, they were all publicly traded joint stock banks, and so you could go out and get data of banks. So just to give you sort of a taste of the data and where it comes from, this was a big historical data gathering project. Emil and I spent about 2 years in the archives tracking down old historical newspapers in each of these countries, getting bank stock prices and dividends, transcribing them, building them up on the aggregate country level to get a bank equity real total returns index for each country. And then also separately, we did the same thing for non-financial total returns. So we have a bank versus non-financial equity total return index for each country. So just to give you a taste of some of the data, this is from a German newspaper in 1871 with bank stock prices. This is from an Italian newspaper in 1904 with Italian bank stock prices. And this is from a Dutch newspaper in the early 20th century with bank stock prices. Now, we did this for every year in every country to build an annual series of bank and non-financial equity returns. Okay, so what do we do with this data? Well, the first thing we do is macroeconomic forecasting to show that large declines in bank equity predict credit contractions and output gaps. This has important macroeconomic forecasting content. And you know, the way to think about this is that we use the real-time and objective information in bank equity returns, which again are sort of a proxy of impairment or distress in the banking sector, at least as perceived by equity markets. And we use this to forecast credit contractions and output gaps. So to do this, we estimate Jorda local projections, looking at the forward path of real GDP, that's the left-hand side variable, subsequent to innovations both in bank equity and also jointly with non-financial equity. And we estimate both bank and non-financial equity returns. We have a non-parametric specification. So we look at whether in a given year and given country, the bank equity index falls by, say, less than negative 45% in a year, negative 45 to negative 30%, et cetera, to account for potential non-linearities in the response of GDP to innovations in equity. And we do the same thing for non-financial equity, non-financial equity over there, to control for the broader stock market and to disentangle the forecasting power specific to bank equity. So our specification has 3 lags of the dependent variables as controls, in addition to country mixed effects. So let me show you some of the impulse responses. So this is the response of real GDP to innovations both of bank equity and non-financial equity. And even though we plot bank and non-financial equity on separate plots, it's estimated in one specification together. So that the response to bank equity is sort of the additional response over and above non-financial equity. We color code it so that when there is a positive innovation equity, when equity goes up, that's in red. When equity goes down, that's in blue. So you can see that both bank and non-financial equity predicts future changes in real GDP. Though the additional marginal contribution of bank equity is large in magnitude. It's persistent over 6 years or longer. It's statistically significant. But most interesting, it's nonlinear. On the upside, there's no statistically significant effect. But when there's a large decline in bank equity, that predicts subsequent output gaps. Now let me show you the same plot, but now the dependent variable is bank credit to GDP. So whether there's a credit expansion or contraction in the aggregate for a given country. Same plots, but actually the effect here is much more stark. Almost no predictability coming from non-financial equity, but there's an even more stark nonlinear pattern for bank equity. When bank equity goes up, there's no response here, but a large decline in bank equity predicts a large credit contraction over the next 1 to 6 years. So, this is again just sort of predictive regressions. This is not causal evidence, but the fact that a large decline in bank equity is followed by a large credit contraction suggests that some of the output decline may in part come through this credit contraction channel. So that's the macro forecasting results. I now want to turn to talking about quiet banking crises, or episodes of non-panic bank distress. So this is motivated in part by a recent paper by Bernanke, who argues that the unusual severity of the Great Recession is attributable in large part to the panics in funding and securitization markets after the collapse of Lehman. But can we say anything about episodes without panics? Are panics a necessary condition for severe economic consequences? Now, to get a sample of non-panic bank distress episodes, we take a two-step approach. We first mark all large declines of 30% or more in bank equity in a given year, and that's what we call bank distress. And then we separate these episodes of bank distress into panic versus non-panic bank distress episodes based on a systematic reading of the narrative evidence. And I want to point out that we were sort of we defined anything that might be construed as a panic, even if it's foreign currency capital outflows, interbank market stress. Be sure that all of our non-panic episodes do not feature anything that might be construed as a panic in any way. And because that's what we're really interested in, these non-panic bank distress episodes. And so if you look at the impulse responses, we see that indeed panic bank distress episodes, that's the green plot here, predict sort of the worst outcomes in terms of real GDP and credit to GDP. Even non-panic bank distress episodes, which are in blue, predict substantial output gaps and credit contractions. Specifically, following a 30% decline in bank equity, these non-panic bank distress episodes in blue feature an output gap and credit contraction of about 2 percentage points. The other thing that's interesting is to sort of look at the converse. What happens if there's a panic but no bank equity decline? In that case, that's the red line, which is not statistically different from zero. These do not forecast output gaps or credit contractions. And this is consistent with the arguments of, say, Kalamiris, who argues that the pre-depression panics in the US were, he calls them temporary depositor confusions with no sort of long-term impact on the banking sector or the macroeconomy. Now, in the paper, we want to point out actually how common non-panic quiet banking crises are, in fact, historically. And we highlight the following historically important episodes. This is just sort of a list of the highlights from like the initial stages of Japan's banking crisis in the 90s to perhaps Italy's tight lending and banking troubles of today. And, so these are episodes where, there was sort of widespread beliefs that the banking sector was deeply in trouble, undercapitalized, and yet because of government guarantees and backstops, there were no runs that emerged among creditors. But yet, among all these events, they were all followed by particularly deep and prolonged recessions. Okay, the third thing I want to talk about that you could do with bank equity declines is you could use the sort of the higher temporal resolution to sort of understand a lot of these historical banking crises in finer temporal detail. And so using monthly stock data, I want to show you that large bank equity declines tend to precede other crisis indicators and talk about what that might mean for the theory of how we think about banking crises. So here, because we're looking at sort of at a finer temporal resolution, we need to actually go from annual data down to monthly data. But because that's a lot more data collection, we're going to only do this around banking crisis episodes. So we're going to have both bank and non-financial equity total returns at the monthly level, and then also compare them to credit spread data. And we're also going to get the panic dates, at least as defined by the narrative-based approaches, and we're going to compare the timing. We have two main findings from this part. So the first is that bank equity So bank equity declines tend to come at the very beginning of banking crises. They tend to precede panics and large credit spread increases, suggesting that substantial bank losses are already present at the early stages of the crisis before the panic. In some sense, large bank losses are already baked in. Panics tend to sort of be the last convulsions at the end. And secondly, bank equity declines tend to precede non-financial equity declines, and especially in post-war and advanced economies, suggesting that narrow concentrated losses start to appear in the banking sector first before appearing in the broader non-financial economy. Let me show you some of these results. And we look at this comprehensively across all the historical banking crises, but I think it's actually very easy to see this just in sort of an example we know well, which is the 2008 global financial crisis in the US. So in terms of thinking about when bank stocks declined, that's the blue line here. Bank stocks actually peaked and started to decline in mid-2007. That was actually the non-financial stock index, curiously, actually continued going up. And it only peaked and declined in very late 2007. And that's sort of curious. So our interpretation is that there were narrow specific losses that were realized in the banking sector, but in some sense, non-financial equity investors, they didn't sort of connect the dots. They didn't realize that these large losses that were appearing in the banking sector in mid to late 2007 were eventually going to turn into a financial crisis potentially and affect the whole economy. And so non-financial stocks actually continued going up and only started declining in December 2007. You could also see that large bank declines are already realized sort of by January of 2008, before Bear Stearns, before Lehman Brothers, before these spikes in credit spreads, before the start of this systemic panic after Lehman Brothers. And this is very general. And so, bank equity had already declined by about 50% before these panics occurred. In some sense, the losses were already baked in. The panics just came afterwards. So we show that sort of more generally across banking crises. It's most prominent in the post-war sample. You see that the bank stocks declined before the non-financials, and the panics and the credit spread spikes tended to come later, about 10 or 11 months after bank equity declines had about 30% had been realized. We use bank stock declines as sort of a way to create a new chronology of banking crises defined by large aggregate bank losses and bank failures. So I'm not going to get into sort of the exact methodology, but we want to use a clear-cut criteria. There's no sort of exact one definition of what a banking crisis is, right? So, but you could define banking crises differently depending on different symptoms, whether there's a panic, whether there are bank failures, whether there's government intervention. So our particular definition that we want to look at, because we think it's macroeconomically important, is large aggregate bank losses and widespread bank failures. And so we sort of sort events based on these criteria. So I mean, here's our new chronology. It's sort of long. I hope it's sort of useful for other researchers to look at. One reason why it's useful or interesting is that we've sort of rediscovered banking crises that have been missed by other historians, because we use bank equity returns as a screen. And we look at all these large bank declines, and then we go into the narrative evidence to confirm them, and we realize that there are a lot of these events that have been missed by modern chronologies. And in the paper, we talk about several of them to show you that, indeed, these are banking crises that have been missed by some of the great modern historians of banking crises. We have an example of Belgium in 1876, or Japan in 1922, which is separate from sort of the well-known banking crisis in 1923. And so this just illustrates another use of sort of quantitative data in the study of historical banking crises. So it looks like I have about 2 minutes left, so I want to sort of talk about future direction. So I've focused mainly this talk on bank equity returns, but of course there's other types of quantitative data that I think is useful, again, for reconstructing the global history of banking crises. So another dimension that is promising, we think, that I'm working on with Moritz and Casper is reconstructing the accounting data, the micro-level data of balance sheets of the individual banks in 17 countries from 1870 to the present, to understand sort of how credit booms happen, which banks are growing during credit booms, the role of bank concentration in financial stability, how the banking sector is reorganized after crises. These are questions that we really need this micro-level evidence to get a grip on. In other projects, I've used, for example, micro-level data on the banking sector to, say, understand the relationship between historical inflation episodes, and we show how they sort of decimate, in many cases, the banking sector and that effect on the macroeconomy. In other papers, like with Tyler and Muir, we use historical micro-level data to assess the effects of the banking sector on the macroeconomy. And in ongoing work, we're thinking about the role of credit sentiment and creating booms that lead to their own demise. So these are just some examples of how this new micro-level data is giving us new insights into the connections between the banking sector and the macroeconomy. So thank you very much.
So I'd also like to thank the organizers for inviting me to come. This is a really exciting conference. I found this paper to be really interesting, really thought-provoking, so I'm delighted to be able to discuss it. The usual disclaimer applies. These are my views. They are not the views of the Board of Governors or anybody else in the Federal Reserve System. So let me start out talking just briefly about what this paper does, and Matt did a very good job of explaining it. I want to give you sort of my take of what my takeaways from it. So this paper talks about the creation of a bank stock index. It covers 46 countries for 146 years. That's quite an impressive panel to come up with a consistent data series. They're going to use this data to create a identified bank distress, which is going to be their declines at 30% or more in the equity index. They supplement this with narrative evidence, and that gives them a chronology of banking crises that they can compare to other chronologies that other people have assembled. One of the advantages of this is they can pick out some silent crises where there may not have been deposit flight, where other people have looked for information on that too. And then they use this equity index to look at the macroeconomic, how this fits into the macroeconomic picture, and they find that there's a relationship, that it's nonlinear, that declines in bank equity are much more strongly associated with declines in macroeconomic output than are increases in bank equity. And I note that there's even further maybe interactions with panics and depositor flight. So in my discussion, I want to start with just a very simple framework for how to think about what they're doing. And I think this is going to at least help for me to highlight sort of what I think that they're doing that's really helpful and important. It provides a little additional context for this sort of what they're doing, and helps fit it with the literature. And then eventually I think it helps suggest some of what they can do with the data that they've assembled, some additional questions that would be good to ask. So to give full credit, they do sort of note the framework that I'm going to talk about, but I think they need to do a lot more to bring it out, because I think it really is having some sort of framework to think about the advantages of what they're doing would be really helpful. So this is old school banking. So what in 100 years or so ago, you had banks that were funded with uninsured deposits, and they have equity. These banks would have cash, and they would make loans to businesses. Those loans to businesses become the liabilities of the non-financial firms. Non-financial firms also have equity, and they have assets where they make widgets, they warehouse widgets, they retail widgets, and the like. And so if you have a macroeconomic decline, then maybe you're selling less widgets, you're warehousing less widgets, you're making less widgets. So the assets of the non-financial firms are going to deteriorate. That, if it's modest, is going to impact the equity of the non-financial firms, but nothing else. If it's severe, it eats through equity of a bunch of these firms, it impacts their loans, that's the assets of the banks, and so if it's big enough, it may start to eat into the equity of the banks. And if it's really bad, then it's going to burn through all of that, and it's going to start making the uninsured depositors kind of nervous about what's going to happen. So just as the depth of the severity gets on, you should see these different claimants affected differently. For those of you who like words, this says essentially the same thing. The only thing to note is that one of the things that's going to matter for how quickly people react is the risk tolerance of the different classes of investors. All right, so how does this help think about what they're doing? So if I take this so I decided to say, well, does this actually work if I go to a place where there's old school banking? So this is an episode I've studied quite a lot, which is the Panic of 1893 in the US. So this red line is equity prices compiled by the Cowles Commission on miscellaneous manufacturing. It's one of the most volatile series in the whole thing, which I'm hoping means that it's related to sort of the smaller manufacturing firms. But it's certainly, you see that that's one of the first things to contract, which is consistent with this kind of there being a real economic decline. This blue line is, blue is for banks, and so you see that that happens next. So the equity holders of banks get nervous next. And this yellow line here is the deposits. And you see that that reacts last, right? So they're following this order of the different asset classes that we would sort of expect based on this old school banking model. This green line here is their equity index, which I'm assuming is sort of the larger firms who may have access to corporate bonds or some other sort of funding. And so clearly, sort of what this may speak to the point that they were that Matt mentioned, that there may be isolated pockets of the economy that are more strongly affected than others. But and so sort of depending on what non-financial firms you're looking at, you may get slightly different things. But at least sort of for my story, this kind of works in this sort of the sense of you see the economic decline passing through the different claims as you would expect. All right. And so how does this help think about their findings? So if we just sort of walked through, if you think about this is how if real economic declines cause crises, then you should expect this ordering. And you should see it in particular during places when this old school view of banking is the most applicable. And that's what they find. So in the 19th century, they see this kind of works. It works less well in later years. And we'll get to that point shortly. You should expect then, based on this, that it's only during the most severe economic declines that you would actually see that bank depositors would react, because there's a bunch of other creditors who are senior to them in this whole structure I've outlined. And that is, again, sort of what they find. They find that the crises with panic outflows are associated with more severe economic outcomes than other crises. And this whole framework also says that because banks' assets are essentially debt claims, you should see that for the equity holders, their payoff structure is very similar to the claims on a standard debt security. And so when there's declines in the value of a debt security, that tells you something that's bad that's happened about your claim. But the upside on debt securities is a little less informative, right? It could be due to things like yield curve moves or monopolistic things, but you don't now expect that upsides to debt is as long as there's no risk of default to tell you a whole lot about the underlying credit quality of the borrower. All right. So then how does this help me think about how their approach fits in with the literature? So they talk a lot about the narrative approaches, but there have been people who tried to quantify these in different ways. So some people looked at risk spreads in corporate bonds, and some people have looked at sudden and widespread deposit withdrawals. And so what this tells you then is that the bank equity should fit nicely into this puzzle, right? So you're looking at a different set of claimants who have a different viewpoint on what the risk of the economy is and how the macro is going to unfold and different levels of severity of things. And so by sort of looking at how your crises, I would expect you to find slightly different crises than these other sort of standard methods, just because you're looking at a different set of claims and people who are reacting to different levels of severity of the situation. And so I think sort of bringing that up and sort of putting your work in that would be would be helpful. All right, so we know that this old school banking does not apply anymore. So here's one way it doesn't. So this is the safety net. And so this shows you, this is from Calmaris and Chen, where they show the number of countries that have adopted deposit insurance. And you can see that has grown markedly in the mid-'80s and '90s. And so they note this, but I think they need to do more with it, right? Or highlight the fact that they're using equity prices, right? Because this is going to have a major impact on the responsiveness of depositors, but it's not clear it's going to have any impact on how the reactions of bank equity holders, right? Because bank equity holders are often wiped out or incur severe losses, even in bailouts. And so using an equity price might give you a nice, consistent chronology that is much more likely to be consistent across time and countries, even once this sort of safety net is taken into account. And so I think that's worth highlighting. But it also leads me to ask, have quiet crises become more common? If the depositors are less likely to react, is that just is sort of this finding of quiet crises just sort of a reflection of this increase in the safety net? And then is when you talk about sort of the pre-war, post-war, is that sort of really is that really an indication of this increase in the safety net causing a different response in terms of how bank equity is responding to the economy? All right, so the other way that banks have changed is their role in financial intermediation. And many people have pointed this out for the US, for the world, but banks have become much more concentrated in terms of their focus on real estate lending. And so if we go back to 1896, you see commercial loans are centered in blue. The red part is real estate, and you can see that banks in the 1890s were much more focused on C&I lending than they were in real estate. Whereas in 2019, you see that they are much more focused on real estate. So that might matter. Secondly, the importance of banks within the economy has also changed, and within the financial intermediation has changed. All right, so this I'm sure could be done a lot more carefully. So I just took the financial assets of banks or depository institutions as my numerator, and I have the total liabilities of households and businesses as my denominator. And you can see that in the U.S. between 1950 and today, that fell from almost 80% to just somewhere around 45%. And so the role that banks are playing within financial intermediation has changed dramatically, and that might matter. And so what I think they should do is they have information on equity price declines for both banks and for non-banks. And so returning to the point I made earlier, can they look and see whether there's been shifts in how these two things are relating to each other and which is moving first and how much is one leading the other? And in fact, if you see that bank stocks are leading non-financial stocks by a lot more, does that tell you something about the nature of the crisis? Does that mean it's much more likely connected to real estate? Are bank stocks moving more with real estate? Does it tell you it might be a currency crisis? So is this difference between the two informative? And then I think it would be helpful to know, given that banks are now a smaller share of intermediation in the US, but I think also certainly across countries, banks have a different role in the economy. So when they're doing these macro regressions and they try to take some of that into account, does it matter that what the share of financial intermediation that banks are doing in the economy? And just to note, it's not obvious that it should, right? Just because banks are not doing as much of the total financial intermediation as they were, it could still be the case that they are key players in what's going on in financial intermediation, and that what they're doing off their balance sheets is at least as important as what they were used to be doing on their balance sheets. And so I think this is something that they could test, and I think it would be worthwhile doing so. Okay, so that's what I wanted to say. Thank you. I thought this was a very thought-provoking paper, and I'll look forward to seeing where your work goes.
So Matt, would you like to reply? We can open up to questions, but if you'd like to reply first, I wanted to give you the opportunity to.
I thought that was a fantastic discussion. I think you explained things very well, so I'll take those comments into account. But I think that just reminded me of something a little different that I wanted to emphasize, which is that, one of the things that's obvious from that came out of our paper is that sort of US crises are a bit distinct and different. And if we just study US banking crises historically, we sort of maybe get the wrong impression of what most banking crises look like globally. I mean, there were a lot of panics in the US. If you look at other countries, panics are actually not that common. If you look at lists of banking crises like by Reinhardt and Rogoff, or take any list, about 40% of them don't have panics. A lot of people don't realize this. A banking crisis often looks more like Japan in the early 90s, where you have zombie banks the government steps in and resolves them or merges them. Panics, often don't actually happen in practice. The threat of them is very common, but in practice they never actually erupt. Events like Lehman only happen about 60% of the time. And so, we study U.S. banking crisis a lot, and we just get this view that it's a lot more fragile and panics are a lot more common than they are in other countries. So I just wanted to emphasize that point again. But all of your comments are well taken. Thank you.
Nice paper, Matt. I have a couple of questions, one empirical and one conceptual. So on the empirical side, I must have missed something because as I saw your initial results, if I were a macroeconomist, I would say the sufficient statistic that I cared about is like output gap or GDP. And if I looked at your financial, non-financial predictability results, they were both there. It's on credit growth that the two predictability, graphs are different. So, which is not that interesting if the sufficient statistic that I care about is the same for the two predictability regression. So I'm curious to hear how you are interpreting it, because it seems to me that both financial and non-financial returns have similar predictability for GDP growth going forward.
Well, they do, but so just to be clear, we estimate them jointly so that they both have predictive power. They might work through different channels. I mean, non-financial equity may just sort of be a barometer. When we know that the economy is going into a downturn, of course you'll see, non-financial equity decline.
But why is the same interpretation not?
Well, it might be true in part for the banking sector. It might also be sort of a barometer of the broader economy, but we also see evidence that part of this effect might be through the credit channel. So sort of there might be different channels, and the bank equity decline in part picks up this credit channel where you see this credit contraction, and that in part is...
So that's the piece I'm not, and that's related to that was my conceptual question basically, which is how can you rule out the story that you just elucidated for non-financial returns, which is that banking equity is basically not just a levered claim on the economy, but a levered claim on the growth options of the economy. And it's also a claim on, because they're holding a diversified portfolio of the economy, so it's basically a claim on catastrophe risk. And so that's what we are picking up, and it's predictive, but it's not causal in some sense. And so
completely agree. So I want to be clear that we don't want to push any particular mechanism. It could just be that bank equity is a particularly sensitive barometer of the macroeconomy. Maybe it sort of picks out household sort of demand or housing or real estate aspects, and the banking sector is just particularly exposed. So it might not be a causal channel, but I guess we're just saying that there's useful information content in bank stocks specifically over and above non-financial stocks that's useful in this forecasting, and therefore useful for thinking about how we should define banking crises in terms of as a way to pick up large bank losses.
Please. So, I have three comments. First of all, I think you should be a little bit more generous in your setup, because you don't mention Jalil's paper, which has this narrative and a lot of quantitative, and Mike Jorda, my colleague, would be quite taken aback as being characterized as a purely narrative historian. Take his early papers off the later papers, which quantify things. Secondly, you don't say much about how you build your indices, and that, I think, the quality of bank equity changes over time. From the late 19th century to the early 20th century, a lot of bank stock is small and infrequently traded. Are these weighted or unweighted indices? How do you incorporate regional exchanges? These are all matters because, for instance, regional exchanges matter. There are some panics and crises which are regional, like the US has lots of unintegrated markets, which, in other words, quality of bank equity changes over time. Also, there's another important dimension. Throughout much of the 19th and early 20th century, bank stock had not single liability, but oftentimes double liability or reserve liability, or a lot of the capital wasn't paid in. That changes over time, and also that should affect somehow how the market's determined. So I think a lot of the questions about how the indices are built should reflect the quality of the data, and that should reflect the interpretation.
So those are all good concerns. So first of all,
sorry, I was just saying also how they're traded, how the stocks are traded.
Yeah, so first of all, one thing I want to point out is that actually the U.S. might be the exception here with bank stocks, because up until the 1920s, banks were were sort of held by block holders. They were not commonly traded, but that was a particular U.S. thing.
It's also true. If you look at the British and French data as well, which I have, you see that oftentimes there's lots of partnerships in Britain. You have the effect that the banks are combining, but there are also regional exchanges. For a very long time, the question is how do you incorporate those, because there are regional economies.
Yeah, so we actually, like in the paper, we discuss a lot of these data issues, and we're very careful. We know that like in the UK, there are a lot of regional exchanges or provincial exchanges, and we're not capturing that. But what we capture is in each country sort of the money center banks in the sort of the main financial center. So in the UK, we could think of the main London clearing banks. In Paris, we think of the main Parisian banks. In the US, we think of the New York clearing banks. So in that case, we might not be picking up financial crises in sort of regional areas. We're picking up we have a definition of a financial crisis and banking losses in the major financial center of each country. And so, but that has macroeconomic predictive content. But in the paper, we are specific about which stocks we look at.
I can probably project. This is going to steal a little bit from my discussion tomorrow, but it's just a question I'll ask again tomorrow. But I found myself wondering, when you think about, you have this rich database of the individual bank stocks, how much it matters about the distribution of the changes in prices, meaning, would it be enough to have a number of sort of stable large banks? I mean, it is a little bit about how your index is created, but I'm just wondering if that's something you've explored. It may not be a feature of the data, meaning when your index falls by 30%, it would be rare to see strong banks that don't have that feature. It's just something I kind of wonder about in these studies.
I think that's a great question. We haven't looked at that yet, but that's what we're looking at next.
You're on.
So in your previous work with Wei, you showed that bank equity prices do not sufficiently price in the crash risk. So if bank equities are priced with rational expectations, and the price dynamics may be different than what's observed in the data. So I'm just curious about the temporal resolution that you mentioned in the paper. So how to connect these two results, and how do we think about the temporal resolution? Is a reflection of objective truth, or a reflection of subjective perception?
Yeah, so that's a good question, one that's often asked. So let me actually point out sort of the timing of bank stocks, right? So in a previous paper, we showed that bank stocks are sort of very high and elevated sort of during the credit boom before the crisis. So bank stockholders don't price in the crisis sort of, like in 2006 or even in early 2007. But then there's a Minsky moment. But that Minsky moment actually happens in bank stocks first. The bank stocks crash initially, like in mid-2007. And then there is that point where bank shareholders kind of get it. Bank shareholders get it first. And then it often takes, another year for sort of panics to erupt. So the first thing that changes, that Minsky moment, actually happens in bank stocks. So that's sort of how these papers are considered.
Let's maybe take one or two more questions, and then we'll move to our next. Saskia.
So I was wondering if you've thought about events in which there was a big drop in output that persisted, that were not accompanied by a banking crisis. And what does that tell us? It reminds me a little bit of World War II and Abraham Wald, when he was asked to determine what parts of an airplane should be reinforced. And so they were getting all these airplanes that were coming back with holes in the wings and in the tail and in all these areas, except in the cockpit and the engines. And of course, those were the most sensitive parts of the airplane that needed reinforcing. But just by looking at the data on the holes on the airplanes that returned, that wasn't quite the right thing to do. And as you were presenting, one thing that was always on my mind was, okay, if I'm a policymaker, if I'm thinking, what is it that I need to do in regard to the financial system to prevent a financial crisis, what is the takeaway from the research that you just done? Because you talked about your quiet financial crisis, but in a sense, I think the more interesting ones are the quiet financial crashes, meaning there wasn't a crash, but there was a crash in the economy. What was distinct about the financial system in those episodes that would teach us what we need to do with the financial system?
That's a good question. We could study that with our data. I don't have that. That's a good question.
It's just very interesting that the stock prices that you showed declining in '07 preceded actual losses manifesting themselves in the bank's reported earnings. So, kind of tells you, what, who knew what and how did they know it? So, I mean, it's hard, I guess, in the 19th century, but it'd be interesting in more recent periods to see when stock price declines occurred as compared to when losses began to be disclosed.
Yeah, so that, I mean, that's one reason to use bank stock prices, because sometimes banks delay, reporting loan losses. They delay the write-downs. In fact, historically, when like with Moritz and Casper and others, we look at balance sheets of banks like in the Great Depression, these banks are wiped out and they never, historically, they never do any write-downs. So in some sense, the accounting data is really not the best guide here, because bankers are always slow to write down the book value of their equity, and that's why the market value is sort of a much more forward-looking and telling way to uncover these types of quiet banking crises.